Hi everyone, welcome back to the channel. Now, before I walk through all of the key charts and data that you all tune in for, it's really been a great few weeks since our last video. The market continues to go into rocket ship mode, and as expected, everything is continuing to resolve to the upside, and I do hope that my work over the last few months has continued to help you in some way. Now, there continues to be massive upside moves in a lot of the beaten up areas of the market. Earnings season is also in full swing. Just looking at the next week, we have some big hitters in the likes of Apple and Amazon reporting, amongst many others. So, as always with earnings season, it promises to be some fireworks. Now, we've had a decision this week on interest rates, another 25 basis points hike for the US. But as always, this month I will walk through a really high level broader market analysis with loads of stocks and ETFs that you can add to your watch lists for the next few weeks. If you missed our analysis a few weeks ago, I will link it at the end. And that's where I elaborate on a lot of the rotations that we are seeing in the market. So you should find some value from my work this month, and hopefully the Scottish accent isn't too difficult to understand. I'm being asked constantly, how far can the market upside go? Of course, this month I have some charts prepared for that, because on one hand we have all of the negative perma bears continuing to scream that everybody's an idiot for buying stocks, whilst on the other hand we've got a lot of perma bulls screaming that the market bottomed in October and to expect all-time highs by the end of the year. Now, just to clarify again, I'm neither a perma bull or a perma bear. I'm very open to all outcomes. As you will see in just a few moments, I analyse the data as it comes in, and managing risk is always priority number one. Now, investor sentiment is continuing to show that there is extreme greed out there, so congrats to everybody else that's been buying stocks. For those of you that have been scared out the market this year, I understand the frustration. Hopefully my work this month can help in some way, because I'll do my best to filter out all of the noise and really just give a really clear context via my charts. Now, for disclosure, myself or our clients may already hold some positions in some of the names mentioned. If you're new to the channel, I like to use a combination of technicals and fundamentals. I'm told that I'm very good at removing a lot of the confirmation biases from my charts. Many have asked for updates to many of the charts that I've been covering for the last few months, so I do have some updates for you folks as well. But as most of you know, I do not use the magical hindsight indicator with my work. I timestamp everything, which is incredibly important. I'm not a short-term day trader looking for tiny 20-cent moves. I'm looking for structural trends in the market that will last weeks to months, and I use systematic process and logical price targets. My work is for everyone, every day. Investors, traders, options folks, financial advisors, money managers, and I'm told that my charts are among the very best in the business. So hopefully they make sense, and if they don't make sense, just reach out. I'll do my best to explain. But my work is really well known in the professional world for my ability to highlight the big risk on, risk off turning points at the right moments. Like I said before, my work is all time stamped. I'm not one of those analysts who make broad market calls before they play out 6, 12, 24 months later. Very few go on the record with their work. I'm one of them. And just to give myself a tiny little bit of credibility, some of our recent time-stamped calls, we could go back to the market crash over a year ago, the bear market rally in June, the rally top in August, the market bottom in October, which is of course massive, the rotation back into tech this year, and we could go all the way back to the crash of 2020, where I got our clients defensive 2 weeks before that event also. So I do have a track record of being mostly correct, which helps. So if you do find some value from my work this month, please do like, share and subscribe on YouTube, and also subscribe, share, retweet on Twitter. It's very much appreciated. Now, please pause the video, make sure you're comfortable with that very important disclaimer before we push on. And finally, if you do need technical analysis software, we have partnered with TradingView. They're absolutely perfect for everyday investors using technical analysis. They happen to be incredibly cost effective. I only partner with the best companies, and TradingView are one of them. But to be clear, this is not for access to our client work. This is purely for technical analysis software. And there's a link in the description for a free 30-day trial. So that's the intro. Let's just dive into some charts here and let's see what the market is telling us. And I think the logical place to start is with the S&P 500. We can see that, of course, Mr. Fibonacci. Now, whether or not you believe in Fibonacci and its merits for the markets, I think the chart really shows just how important these levels are for the market on a technical level. We have recently reclaimed the 4420 level, which I think is wildly bullish in my world. But what I want to do is actually take a little step back here and just go back to the yield curve. Now, I do like to cover the yield curve every month. It's obviously really important. We know that when we start to come out of the yield curve and it starts to advance to the upside, that's really where the danger is, I think, with the stock market. That's certainly what I've learned over the course of the years. And we can see that we are continuing to decline here. Now, I know the whole economy versus the stock market gets a lot of airtime. For me, of course, if we're buying stocks, it makes complete sense to assess the stock market. That's just logical. But I am very mindful of a lot of the economic indicators. I do use a few of them. We can see that with GDP, we have recorded another positive quarter for GDP. I cover this, I think, maybe for those of you that are new to the channel. We did actually have two negative quarters of negative GDP last year, but for whatever reason we were told that this wasn't a recession, when it's been evidence of a recession pretty much every time in the past. So there's going to be some revisions at some point. That's my gut feeling. So at the moment, I'm working on the assumption that we've already had a recession, or we're in a recession at the moment. I don't know about you, but it feels like a recession. I've got friends that are taking on, second jobs, etc., just to make ends meet. So I do understand the other side of things. It's not all sunshine and roses out there, although the stock market is very close to all-time highs, 5% to be exact from all-time highs. We are continuing to see the resumption of the uptrend. But one of the things that, and one of the myths that I'd like to dispel this month is the nonsense that it's only 5 stocks that are driving the stock market. That couldn't be further from the truth. The equally weighted S&P 500 is now $7 away from testing all-time highs as well. And when you look at the individual sectors for the equally weighted S&P 500, and these areas of the market have all been going up since October. So this narrative that it's only 5 stocks is really being banded about by folks that have just got zero clue about what's actually going on. They're masquerading as analysts and professionals when they don't even count, and it just baffles me that anybody listens to them. But that's a discussion for another day. We've got the S&P 500 value index again going out at new all-time highs. Looks like this week. Just to clarify, I am recording this analysis around 2 hours before the market close on Friday. I will just quickly run through the major averages and what's going on with the market, and then I will of course get into the stocks and the ETFs. We've got the NYSE composite, again, new 52-week highs. That's not bearish for the market at the moment. We've got the Dow Jones Industrial Average, which has recently broken out. We are just again a few percentage points away from all-time highs. The triple Qs have come under pressure a little bit over the last few weeks, but they are rebounding from those February and March 2022 levels. So again, I'm not seeing a lot of bearishness out there. There is a narrative that tech is about to collapse any moment. I do understand where this is coming from. The reason I understand is that, if you look at some of the charts, Nvidia and Meta, which I will get on to in just a couple of minutes, a lot of those stocks have had ridiculous moves over the last 6 months, and these types of moves in the mega caps aren't sustainable. So I am starting to see a lot of bearish sentiment when it comes to technology. And for me, although I am working on the thesis of rotation at the moment, if technology starts to break below these December 21 levels and we start to see failed breakouts, that's where the headaches start to come in. And just to bring back the S&P for a second, the failed breakout is one of the earliest warning signals that the market will generally give you before big declines. We can see that with the COVID crash, the 2022 crash as well. So I am very, very mindful of the potential for a failed breakout here in technology, but I don't like to overthink and overcomplicate the market too much. It's really just about the individual stock and the individual sectors that you want to be aligned with. I think if XLK is above those December 21 highs, then I think you can continue to be bullish all day long. We've had a massive rotation into the small cap space over the last few weeks. Again, we are continuing to move higher. For me, again, this is a Fibonacci chart. I think the Fibonacci levels ultimately matter here for this particular chart. So I am expecting another few percentage points up to about 203 with the Russell 2000. The All Country World Index, it's not just the US markets. We're seeing it with stocks around the world continuing to advance, and they are moving towards fresh 15-month closing highs. The inverse correlation with the US dollar looks to still be intact at the moment. So the US dollar for me is still front and center of absolutely everything. We can look at the shorter term time frame for the US dollar index. So if the US dollar index is going to advance here, you will start to see some areas of the market start to come under a little bit of pressure. I think technology would probably come under that bracket, but again, not overthinking it. I will assess the XLK chart and the triple Q chart on its individual merits. But the US dollar index could potentially be putting in a failed move here. The 10-year note looks a little bit basy to me. So again, the big question is what happens if the 10-year Treasury note yield breaks out to the upside. But I am working with the thesis at the moment, and I have communicated this to our clients over the last couple of weeks. The levels that I'm fully expecting us to test are those all-time high levels. This is my one chart snapshot of the market. I think I'd be very, very surprised if we didn't start to see these levels go and test these all-time high levels. And what you'll probably find is when one of them tests the levels and declines, it'll probably trigger some kind of chop within all of them. So this is one of the charts that, of course, I'm keeping a very, very close eye on. But it's very, very difficult to be, bearish on the market as a whole when we've got industrials breaking out of a 2-year base. For me, that's not evidence that we're in a bear market. We've got commodities which certainly have been coming onto my radar over the last few weeks. I think the commodity space is really a space for, I think, the professionals out there, certainly the professionals that I provide work to. They're looking at the commodity space with a lot of interest at the moment. I have made some recent bullish calls on the likes of copper, the oil markets, the energy markets, and I think it will be full risk on in the commodity space if we can get a breakout back above these levels around 110. And the Bloomberg Commodity Index is the chart that I like to use as my gauge of the commodity space. We've got gold, again, gets a lot of attention. For me, the level here with gold is 2100. Again, it's a textbook Fibonacci chart. For me, I think if it's above 2100, then I think with gold, certainly that brings in 50% upside. But just to be very, very clear here on gold, it's not an area of the market that I buy, but what I am more interested in are the stocks aligned with gold. And of course, I'm talking about the gold miners, the junior miners. Those types of stocks can blast off like your growth tech names. So that gold chart is really worth watching, not for gold per se, but for the impact that it can have on areas that can blast off 20, 30, 40% in a matter of weeks. XLF continues to hold up, so I find it very, very difficult again to be bearish in the market whilst we have financials continuing to hold up above those financial crisis levels. And again, it looks like we're going out another positive month for the financial space. The regional banks have recently broken out, but just to be clear with the regional banks, we made a capitulation call on this a couple of months ago, the exact bottom, and I think with the regional banks, there's certainly a lot of strength that's starting to be shown in some of the names. I don't subscribe to the narrative that the financial system's about to collapse. I think it's good for headlines, but not necessarily for your investment portfolios. Semiconductors now, of course, we're looking at semiconductors with a lot of interest because there's a lot of names within the semi space that make a lot of sense. I think if semiconductors can break out on an absolute basis, which it's trying to do today, then potentially we could see some moves in the semi space. And I know that seems crazy to say because we have already seen some massive moves in the likes of Nvidia, etc. this year, which the chart I will get onto in just a few seconds. But it has broken out of a massive base on a relative basis. So if it can break out on an absolute basis, then semiconductors could potentially take the next leg higher. Now, I am just about to run through around 20 individual stocks. If you're still here, it tells me that you're getting some value from my work. So please do hit the like button. It helps to get my work noticed and it would be really, really appreciated. So let's start off with Nvidia. Now, I have the same concerns with Nvidia as I'm sure most of you have massive PE ratios, negative earnings growth, high price to sales. But for whatever reason, we've been on a rocket ship. Now, just to be clear, we've been bullish on Nvidia for a long, long time. That's the chart that we put to our clients earlier at the end of last year. But we have recently hit our upside objectives. Now, I think I said around 3-4 weeks ago in our last video that I had actually sold my position in Nvidia around $400, and that's still the case. It's obviously moved an extra 10-15% without me, and that's fine. But we've met our upside objectives around $500. I think if there's a breakout above this level, that's an environment where semiconductors are breaking out, the SMH chart is breaking out, and again, as crazy as it seems, if Nvidia is going to break out above that $500 level, that's a massive psychological level for the market. Nvidia has lofty price targets from a lot of the investment banks now, up around $600, $700, $800. And I think if it's going to achieve those numbers, then it has to, of course, get above this confluence of Fibonacci levels. We've got MasterCard chopping about a little bit. Still can't get this breakout in the continuation above the $400 level. I think if it can get that, this is a 2-year base, then that brings in $535 as a potential target. Now, for those of you that follow me on Twitter, of course, if you're a member of ours, you'll know that Boeing has been a chart that we've posted this week. Massive upside breakout there in Boeing. We are working with upside targets there around 278. Uber continues to do incredible things. We've been bullish on it a while, but it does look like it's breaking out above the next price level. So again, we have a systematic process that we work with here. So if there is any big decline in the stock, then of course that would trigger things like stop losses, etc. Amazon disclosure, of course. We've been covering this one on the channel for quite a few weeks now. We have earnings coming up next week. We've been bullish on it from $100. We do still hope to see $145 hit. There was a little bit of an excursion there below on Wednesday, but ultimately it's rebounded pretty well. So again, I think with any earnings, I think it's really good to have some kind of earnings plan in place. And what I mean by that is having a rule set that says, I will only hold through earnings if I have X percentage profit in place. I think for my work, I advocate having at least 10% profit in place in order to hold through earnings. It just helps with the whole earnings holy shit moment where you've got the market just selling off and it gaps down below stop losses, etc. I find that having that 10% in place helps a lot. So hopefully that's something that you can take with you. Again, same with Apple. We've been bullish on this for quite some time. Ultimately, we want to see this breakout above the $200 level. There is a slight bearish divergence, but I'm not overthinking that too much. It does look like we might potentially go out at a new closing all-time high. So again, we'll see how Apple develops over the next week. Big moves obviously in Meta. Congrats everybody that's still holding Meta. Again, we've been covering this on the channel for it feels like forever now. Just to clarify, we're working with our upside targets here at 350 now. I've had to actually bring in the monthly chart here just so that I can fit everything in. But hopefully this shows why we've got a target of 350. Just these levels dating back to November and December from 2021. But there are, of course, lots of names that are potentially just getting started. DraftKings, as crazy as it seems, disclosure, but it does look like it might potentially break out again here. PayPal, again, one of the charts that really we look for with buy low, sell high, which seems really a silly thing to say, but there are times where you've got stocks that have been beaten to death and then they start to show early signs of a recovery, and then what you often find is relative strength comes in. So I think PayPal makes sense from a lot of angles. I think if it can break out above the 200-day SMA, simple moving average, which it is struggling with at the moment, but I think it's just a matter of time. And I think if there's a move here in that $75, $76 level, then I think it's probably game on in the next leg higher for really a stock that's been beaten up a lot. MGM, potentially a breakout above $51. It is outperforming the S&P 500 year to date by around 27%. We've got JP Morgan continuing to move higher. I have covered JP Morgan in the past. We are working with an upside target there around $172, which would represent previous all-time highs. Maybe a name that's maybe gone under the radar a little bit, I think, for many of you that really just stick to the tech and the growth tech names, but there are lots of big moves taking place in the energy space. APA Corporation has been one of those. It's a $12 billion energy company, really low PE ratio. I think if this can break out there above that 41.50 level, then that brings in the second target for us, and I think it might make sense for some of you that are looking for some exposure into the rotations in the market in the energy space. Now, INMD has been one of our buy low, sell high charts. Now, massive sell off in the last 24 hours with this one on the back of what I view as largely positive earnings. Now, this is something that I specifically look for. I call it the earnings discount. So I'm really just building in support levels to see where price might rebound here. At the moment, it does look like there's a potential mini rebound taking place at the moment from logical levels, but INMD is one of those companies that I like a lot. So I am looking at this as a potential buying opportunity. But it's really just a case of finding out, waiting for the support to confirm that buyers and meaningful buyers and the institutional money is starting to move back into the stock. Now, ON, it's unusual for me to do this actually, but I think that there's maybe some learning to be had from this, because I think there's maybe a lot of you out there that are maybe trying to time the market with little 20-cent stop losses, etc., because you've learned from all the day trading gurus all over Twitter or YouTube or whatever. But this is actually one of our high conviction ideas that we sent out yesterday for ON. Now, with ON, it's a footwear company, and yesterday there was a massive intraday sell-off because of the Crocs earnings. And because they're obviously apparel footwear, we start to see sell-offs across the board. And ON was one of them. And ultimately we put out our alert in the morning. It sold off. But this is why it's really important to have systematic processes in place, because when you understand what the key levels are, you often find that we get these reactions that offer buy the dip opportunities, and this is exactly what's happened with ON. And today there's been a massive intraday rebound. It was down 5%, but it has rebounded from logical levels. I've obviously communicated this to our clients this morning already, that there's nothing wrong with the chart's still intact, and ultimately now when it comes into next week, I hope to see ON holding move to the upside. So we'll see how things develop there, but I think that actually why systematic process and having a rock solid foundation for an investment thesis really helps. It's not about timing the market and hoping to get in and tiny stop losses, because if you have tiny stop losses, the market will just eat you alive, and it's why day traders can't really find consistency. You've got the 3M company again. This was provided in the last 2 weeks. Big rebound from the September-March 2011 highs there. So it's doing as expected at the moment. So again, it's really just a case of just applying now systematic process and seeing how far 3M ultimately wants to go. Chemical space, again, I understand it's not going to be front and center for many of you, but this is where you have a lot of the low PE ratios and the solid earnings growth, and these stocks can move 20, 30, 40% in a couple of months. Mosaic has been one of our chemicals plays, and I think if it gets above $43, then it's potentially the next leg higher. Costco continues to move higher, breaking out again. We've got a 610 target on it. Archer Daniels, again going back to the commodities, agricultural space. One of our buy low, sell high charts is potentially breaking out again with 18% upside. Massive moves in CLS. breaking out above the 2005-2017 highs there. Again, this is one of our premium charts that I'm sharing with you. Again, low PE ratios, solid earnings growth. We've got CF Industries, again going back to the chemical space. For us, it's already met target 1, but potentially if it can break out above the next level, then that's going to bring in those 114, 115 targets. Berkshire Hathaway continues to stair step. I've been covering this one for months. Our target on it is around 360. Home Depot, again, I think if this can break out above that 345, 346 level, I think there are signs here that HD could potentially start to outperform the market. It has been outperforming the market over the last few weeks. I think that's something to highlight. So again, it's close to meeting our first targets there, but I think that ultimately we want to see the money, the institutional money that's maybe forgot about Home Depot, start to maybe pile in a little bit. K-Web, when we look at China, we're starting to see some massive moves in China. Some of the names that we've been covering, XPeng, obviously the Chinese EV companies have been on a rocket ship here. Hopefully we can get up to that $35 level. And of course we've got Alibaba, which is, in my opinion, showing a lot of signs of potentially basing. So again, I'd expect probably a test of that 123, 124 level, which represents a further 20% upside from current price levels. So I do hope that you found a lot of value from this analysis. Please do hit the like, share and subscribe button. If you are wondering who I am and what it is I do, please do jump on to our website at honeystocks.com. We provide memberships, subscriptions to all of our premium work, provide access to our weekend premium analysis, our high conviction investment ideas, which I'll show you what that looks like in just a second. We provide access to our midweek halftime report. We also provide access to a wonderful community of experienced traders, investors, money managers and skilled chartists, also contributing their own insight. You have access to all of our chart books which cover the stocks, the ETFs and the commodity space that we cover for our clients and our professional clients. And if you are in the process of maybe learning a bit more about charting and technical analysis, I'm told I've built out one of the very best technical analysis programs, which helps newbies and beginners really start to build a process. So that's included with all of our memberships as well. But just to quickly show you what our high conviction investment ideas look like, Tesla has been massive on 2 occasions this year, massive gainers. Meta, obviously, is still massive. Recent one that went out for DraftKings has been obviously massive as well. Recent one for JP Morgan has been great. Amazon, again, very different style of setup and chart, but again, it's been massive. Home Depot doing very well, as I've just demonstrated, and Apple has been massive as well. But I'm very unique in what I do because I timestamp all of my work. All of our high conviction ideas are logged on our website for open transparency. So feel free to check that the types of stocks that we like to recommend are the types of stocks that you like to buy. I've done this every single year over the last 5 years. So please do check that out and do your due diligence. But I think generally our work is really a really good fit if you have a mid-term approach and you're looking weeks to months out. Maybe you're somebody that keeps losing at day trading, you can't make that thing work. Maybe you're looking for building systematic process and adding technical analysis to your skill set. Maybe you're just too busy with work, life, family, business to find the best stocks. Maybe you're an investment manager, money manager, and you just want to have a different perspective of things. You have access to me on a daily basis as well, and maybe you're sick of hunting around social media. So whatever your deal is, please do check out our website. There's lots there for you, but please do hit the like button. It makes a big difference, and thank you from the bottom of my heart for watching. Have a wonderful weekend. Thanks.